Investing Accelerator. For this week, we have a relatively shorter week where we are going to first talk about what I think about interest rate increase and how that impacts the market for each of the major sectors. Afterwards, we're going to talk about quick update, the tension between US and Ukraine and Russia that is currently spiking oil and gold prices. Actually, we'll be talking about this first. And then afterwards, in terms of quick updates, we'll be including Netflix as well for entry. In terms of stock picks today, we only have APPN from Rob and also Etsy from Rob. Previously, I was thinking whether we want to cover Etsy, but then we will be covering that as well. All right, so let's start from the beginning. If you have been wondering on Friday, why is the market suddenly down except for oil and gold? And that is because US is saying that Russia will be attacking Ukraine next week. Currently, there's going to be a talk between Biden and Putin tomorrow, and then we'll see how that goes. I expect this is actually spiking up oil price. US oil to over 90 now. Right now it's 93. It is actually quite possible to hit 100 given the uncertainty of the situation. I suspect for the next couple of weeks, the oil price will continue to go up. For gold prices, it is also spiking up. So right now it's at 1858. Gold prices has been in this consolidation period for a long time. We'll just have to observe if this level of uncertainty is enough to push it over 1900 or even potentially touching 2000. If you have gold stocks and you're planning for an exit, then I think in the next couple of months, if it does spike up to that kind of level, like 1900 to 2000, then your gold price stocks will be going up as well. Make sure you plan for an exit during that time. Okay, that is that. Let's talk about the market before we do individual stock companies. Steve, interest rate increase. Could you let us know your thoughts about how we should plan for the Fed rate hike that will happen in March and other interest rate hike this year? The market has been very volatile and highly unexpected inflation really hurts the markets. Thank you. When Fed is talking about interest rate increase, there's really market fear. That's why the stocks are going down, but it is just a fear, but not what's actually happening in the market in terms of fundamentals. The fundamentals of those companies have not changed yet, but it is reacting to it based on the news alone. For interest rate increase, technology sector declined due to fear of unprofitable business going bankrupt, and housing sector declined due to fear of defaulting on their mortgage payments. Some people who are a little bit tight on cash can potentially default and not being able to pay for the additional payments. That is really the concern. Technology companies' reality. So profitable technology companies will prevail. That's why you need to look at fundamental analysis. Companies with huge cash balance will prevail. A lot of companies during the boom, they have already raised capital. Then they have a lot of cash on hand, so then they will be able to weather through the storm. Those ones are good ones. However, the fear will still drive down stock prices. Right now, we observe some technology companies are giving back all of their COVID gains, including Facebook, Netflix, PayPal, Square, Tdoc, also medical companies such as Moderna, COVID-driven stocks such as Peloton as well, Peloton. When you think about what's happening here, for example, Facebook, Netflix, PayPal, Square, these have very strong financials. They're going to be fine. Whereas for Tdoc, Moderna, there is also another trend where we're stepping out of COVID. That is slightly against them, which is why it is dropping. I can just show you quickly. We'll be talking about Netflix later today. But here you can see that is the sharpness of the drop. So what you're really waiting for is a more solid bottom. And for Moderna, the second issue here is really the overall economy is stepping out of the pandemic. Right now, we're really heading towards a post-COVID world. Then you should focus on post-COVID stocks, which I'll go through in a bit. Housing reality. People who have fixed rate mortgage will probably be fine for the next couple of years. People who have variable mortgages will be fine right now as the payments are fixed. But that really depends on how the mortgage is structured. For example, for my mortgage, if the interest rate increase, it actually does not change the payment itself. What it changes is the amount of interest I'm paying on a monthly basis versus the amount of principal that is being paid down. So then by having an interest rate increase, for now, there's actually no impact to my mortgage. But in 3 to 5 years, when it gets renewed, then that's when you will see the remaining payments plus the increase in interest rate. This means the real problem will be refinancing, which may happen 3 to 5 years from now. So for the next 3 to 5 years, it will still be a bull market overall, mainly because of housing shortage, supply chain shortage, or whatnot. We see that housing companies already reflected the fear in the interest rate increase and have gone down. So here is Redfin, Open, and Zillow. These are actually the technology housing companies, which means they're getting hit especially hard. Here you can see, first there is the boom for Zillow. Now there is also the iBuy program problem that is kind of built into this. But now you can see Zillow is forming a W here. And then Redfin, another housing website. Now you can also look at construction companies as well. Then you don't have the technology impact that is kind of influencing all of them together. And finally, Open. Here you can see right now it's at a very cheap price. These have already crashed in anticipation of the interest rate increase. They are relatively cheap. It's a matter of the housing shortage kicking in, and so on and so forth. So you can also look at renovation stock, kind of like interior design. I think we covered a couple of those earlier, and any construction-related companies as well. Commodity. Theoretically speaking, the increase in interest rates will lead to a decline in commodity prices. However, we also have a supply chain shortage, and interest rate has not actually increased yet. For example, technically, if interest rate increase, gold prices should be going down because people will be more inclined to invest in bonds instead of gold. So that is the concept here. But then if there's also a war between Ukraine and Russia, then that kind of fear will keep the gold prices high. That's how you should think about the situation. That's why right now a lot of basic commodities such as iron or copper are still at all-time high because of that supply chain shortage. I do expect commodity prices to calm down in the near future, but it's heavily dependent on the supply chain crisis, which is China instead of interest rates. Given that China is still battling COVID, they're still closing its borders. I don't think commodity prices will be going back down anytime soon. Late stage interest rate increase. So what I've covered here is really the fear of interest rate increase. So right now, Feds has not increased the interest rate yet. We're still in the rumor stage. People are still talking about it, how much it is going to be, how often it is going to be. There's a lot of fear built into this situation. Now, once interest rate has increased a couple of times, so I'm talking about after June, this is like 2 or 3 times increase, like September or December timeframe, then people will realize that, hey, interest rate increase is okay. We don't need to panic and start investing again. We shouldn't encounter any problems until the default rates for properties increase or companies start going bankrupt. If the interest rate increase and people are able to live with that, meaning that increasing by 0.25% or 0.5% does not crash the market, that will restore people's confidence. Hence, the market will be going up. I expect that for the March increase, there's going to be a slight drop, and then the drop will be reducing over time as people gain more confidence. Now, for oil and gas, it heavily depends on oil and gas price shortage, and winter is probably coming to an end. The only thing that is keeping oil and gas high is really Ukraine and the Russia conflict. You will have to see how that goes. Once this issue gets resolved, then the oil and gas price will probably come down. I would say the oil and gas run is pretty much 80 to 90% done. Now, you might be interested in when was the last time Feds increased their interest rate, and you want to look at this and compare to S&P 500. If you look at this chart, then you will see there was an increase back from 2005 onwards, and also 2016 onwards as well. If you go back here and go to SPY, and you zoom out, and you look at 2015-16, look, even if the interest rate increase, it continues to be a bull market for 4 or 5 years until you hit COVID, of course. And it's a relatively short crash. Anyways, the next one is really 2005. 2005, this is where you still get a bull market for a couple of years until you get mortgage fraud. That's when you get the 2008 financial crisis here. You need to think carefully that, hey, perhaps it's going to be fine for a couple of years until the mortgage fraud kicks in. Every single crash is not going to be the same. Even if there is a mortgage crisis back in 2008, it doesn't mean it will be repeated because banks will be smarter. That delays the crash further. They probably have better controls to prevent that from happening. Okay, just because interest rate increased by 0.25%, it doesn't mean the market will go down immediately. It will probably take some time for the effect to kick in. That's the point. All right, going forward, what you should focus on. Airlines, travel. As our North America are abandoning COVID measures, some states are not requiring masks anymore, no more COVID restriction. We're seeing airlines to start going up as well. I expect this summer, airlines and airline stocks will be quite popular, meaning people will be flying, and the stock itself. So DAL, UAL, ACBA. I also expect travel stocks to be quite popular as well, like Expedia, Hotel, Airbnb. So I looked at hotel stocks, and it is really not at a discount at the moment. I think airlines are still at a discount. Let me just show you. For example, UAL, you can see it is still within range. I think once they post more financial results, then it will break through this red and blue EMA. So DAL, same concept here. AC, this one. So AC here, you can see it just touched the upper Bollinger Band. It was just waiting for the breakout, and Boeing. Yeah. So right now, a lot of these airline-related stocks haven't broke through because I think on the global scale, there's still restriction when it comes to flight. Now, when you're looking at hotels, for example, like Marriott, it has already recovered significantly because there is domestic travel. I think that is good. For example, Hyatt, you can see it is not really at a discount. Hilton, I think Hilton is HLT. You can see these stocks are not at a discount at the moment because the market already reflected that from the domestic travel side. I think the only one that is probably at an okay price is Airbnb at the moment. You can see right now the price is actually fluctuating between 140 to 200. Looking at the growth, it should be having an uptrend in the future. Looking at the fundamentals, it should be having an uptrend in the future. But for now, it's just kind of fluctuating in the middle. I think if you are using stocks, long-term hold Airbnb, it should be okay. If you're expecting to hold till, global travel fully recovered. Okay, I think a breakout will be happening for stocks such as Airbnb later this year, probably after June. The next one is entertainment. As people start to travel, I think traditional retail entertainment will gain traction again. For example, Disney is reporting good earnings after the parks are full and more movies are coming out. Disney, previously we included it in the quick update, but now I'm taking it out because after the earnings, they are reporting that the parks are reopening like we expected and people are going to Disney parks, and that leads to a jump in terms of the stock price. If you are interested in Disney, I think there is still an opportunity to enter right now. The movies are coming out later this year, like Doctor Strange or whatnot. Here you can see red EMA and blue EMA, and right now Disney is still in the middle price. Because of today, it actually has gone back down to the middle price. So if you're looking to enter, I think this is a good area to enter. And you can see the W formation as well. Now, this is not a very perfect W formation. In fact, this is a lower W. So then it is possible that it might fluctuate between this area. For example, like it bounced down a little bit to 140 before going back up. Or Disney might hit 170, like the upper BB band as it comes down, and then come back down before going up as well. But either way, I think this is a relatively good price for Disney. So the next one is China. Some stocks are dependent on China for growth. Right now, China is feeling the pressure on growth due to poor real estate sector, poor technology sector due to regulations. China has recently ordered its own private equity funds, state-owned enterprises, and funds to start investing in real estate and technology again. However, China should be gearing up to reopen near the end of the year. This means China stocks should recover. However, the delisting issue will still persist. So I don't think they have resolved the SEC delisting issues yet. I don't think China has, so they are working on it, but I don't think it will be in effect in 2 years. There is still a little bit of time for them to resolve this SEC issue before it escalates out of hand, basically. Here is the article where China firms is getting boosted by state funds buy stocks. This is China funds buying back their stocks. Okay, they call themselves a national team, and then they're buying back their stocks to support the market. For example, if you look at Tencent, it's just hovering within this area. It hasn't broken out yet. If you look at Baba, I think it's also kind of hovering within this area as well. Here, you can see the bottom is being formed, but it hasn't broken out upward yet. If you do plan to invest in China stocks, just make sure you keep your exposure low because it is high risk and the delisting issue is not resolved. So then the risk is still there. Okay. Now, some stocks also depend on China for growth. So they will start to pick up as well. One example is Starbucks. If you're looking to invest, I think later this year, Starbucks will probably be able to continue to grow in China. Right now, it is still heading downward, closer to the blue EMA. So then once you see price stabilize, probably in March or June, then I think there is a potential for it to go up. Starbucks depends heavily on China for growth. Technology correction will come to an end in 6 to 9 months. While we don't know exactly when the technology correction will come to an end, but I think it will be happening soon. We can already see Bill Ackman buying Netflix after the drop. People are buying Facebook after the drop. We just haven't seen the bottom yet, but it should be coming soon. I think every time the interest rate increase, it will create a wave, kind of like a small correction, but it should get smaller over time because people realize that it's not the end of the world yet. Okay, that is how I think about the interest rate increase. With that being said, we'll go through the remaining stocks like the quick updates. So GPN released earnings this week, and surprisingly, it didn't drop. Now, I know some of you decided to close your hedge. For myself, I still will hold on to it for now because we'll see which direction does it go. If it goes up to this red EMA area, then I'll be exiting the put and the calls together at an okay profit. If it does come down, of course, I'll just take profit on the hedge. The second one is MasterCard, Visa. Those ones, we covered that already. If it does come back down, then there is an opportunity to buy. You can track that for MasterCard. For Visa, if it does come down to this 210 mark, I might be adding, or 215 mark, I might be adding. But yeah, we'll see how it goes. I think it mainly depends on the Russian-Ukraine tension. Now for Square, initially it was going up this week, but then I think it just retraced down. So you can see it is not forming a bottom yet. It's still early. Same thing for PayPal. Now for PayPal, one interesting thing is that insiders start buying. Insiders are saying this price is relatively cheap. And here you can see this is the president CEO. If I just click on Daniel, president CEO is buying. Frank is a board of director, and I think David is also a board of director as well. Yeah. Then they start buying the stock now. I expect there is some level of support at this 120 mark. Right now it's at 115. I suppose it should be bouncing around this area. Okay, so it should be bouncing around this area. So if it does bounce to 100 and then go back up, I wouldn't be too surprised. I still have the put open. This is a partial put now because I didn't add a put position for the latest order. I'll see when is a good time to close it. It might be down near 100. Then that's when I'll close my put. All right. The next one's Oracle, Facebook, Lulu. For these ones, I think we can keep watching for now. Initially, it was going up, but I think on the very last day, because of the war tension, it is going down. Here you can see Oracle earnings is coming up, and Facebook, it is still going down. It hasn't stopped dropping yet, so it's just a matter of waiting. Same thing for Estée Lauder. Here, initially it was actually going up, but now it's dropping a little bit. And OLED earnings will be coming up as well. Right now it's hovering really near the lower parts of the Bollinger Band, but it's actually quite a good price. I do think there is a possibility if there is a bad earnings, it might drop to this 120, 110 level. Just a matter of waiting and see how much the market panics. We covered that. For CRM, there is like way too much insider sell. I'm not a big fan of investing in CRM. For now, I'm just going to take this off. If you want to invest in CRM, then make sure you track it. But I think compared to all the other companies, you don't see Facebook having a lot of insider sell. So then why does CRM having so much insider sell? So Facebook, so not forming a bottom yet. So it's just a matter of waiting. Shopify earnings is actually coming up in a week or so. If you are interested, make sure you are tracking it. Or if you invest before earnings, then make sure you are using a put as well. So earnings is coming up, and right now the price is relatively cheap. Yeah, so later on, we'll also be talking about APP and Etsy and Shopify and how they might be related. AMD, NVIDIA, I think this is also down for now. So here you can see it hasn't broken through the trend line yet. So chances are it will be bouncing near this lower Bollinger Band and red EMA area before going higher. If you're wanting to invest in semiconductor stocks, then I think in the next couple of weeks, it will be a good opportunity. ADSK Roku. This one, you can see it hasn't broken the trend line yet, so it's just a matter of waiting. I think it should be the same thing for Roku. I think for Roku, it is getting pretty cheap already. I think it will probably bottom out near end of spring or summer. So if you are looking to invest in Roku, then I think you should be watching closely for now. Okay, we covered that already. Okay, so we want to do a quick update on Netflix. The company's Q4 is still growing, but the cost of goods sold increased. I checked their press release, and it didn't really include any meaningful information on why the cost has increased. I suspect it is the cost of the content that led to lower margin. They're expecting margin to be flattened in the future as well. The drop is mainly due to decrease in subscriber growth. The drop in the stock price is mainly due to some slower in subscriber growth. Okay. First, let's go to here. After the earnings, Netflix has dropped significantly, and right now there is kind of a price stabilization for a couple of weeks. Now, this bottom is relatively early. I do expect a wide range for this bottom. I expect it to actually fluctuate around here. Even if it drops down to 350 again, I wouldn't be too surprised, but it's going to be a volatile play. Now, when you are looking at Insider, one of the good things about Netflix is that there's actually a lot of grants because obviously insiders know it is cheap, and there's actually open market private purchase. This is, I believe, is the president, CEO, and chairman of the board. He's basically the founder here, and there's a lot of insider buying. That, I think, is one of the reasons why Netflix is quickly, in terms of price, stabilizing. When you think about it, Bill Ackman also bought Netflix after the drop. The president, CEO also bought Netflix after the drop. So that gave people a lot of confidence. I think there is a strong layer of support here. And that is also the reason why when PayPal has insider buy, I was buying PayPal as well. Okay, that's what we're looking for. Now, when you're looking at the press release, let me just bring it up here. I think it's easier if I show you this first. Now, when you're looking at the earnings, here you can see the growth actually is slowing over time. Netflix is becoming a more mature business on an annual basis. If you look at the net income, it is growing, which is fine. Now, when you're looking at quarterly, that's when you get the additional information you're looking for. When you're looking at quarterly, you can still see the revenue is growing, but that is good. But the issue is the cost of good sold here, where it is also increasing rapidly. There's a $1 billion increase from September to the December quarter, which led to basically the same gross income when they had 6.64 billion revenue versus 7.71 billion revenue. Here you can see the gross income actually didn't increase, and that is why when you're looking at the net income, it was a little bit higher, but it's not that much higher, even though the revenue is so much higher than the December 2020 quarter. When you're looking at this line, and then you go to the press release, here, when you compare, it is really this cost of revenue line, which is not related to marketing, not related to technology, and not related to general administrative like headquarter costs. This, I think, is actually the cost to produce the content, like all the TV shows that are Netflix exclusive. I think over time, the reality is the cost to produce content is quite high, and they're investing more into new content. If you think that is the right thing to do, which I do think is the right thing to do, then I think, the operating income is getting squeezed at the moment, and they should be able to maintain their competitive advantage that way. If you read the press release, then here you can go back up to see that the Google searches, you can see most are Netflix. And the other one is actually just Disney+. If you just look at the market share from Google search, right? Loki, WandaVision, Eternals, Black Widow, Shang-Chi, Cruella, these are all Disney-related ones. So there might be more, like for example, I don't know if Godzilla is owned by Disney. But I would say Netflix have a good chunk of the market share. That is what they need to do to invest and maintain their market share. If you're okay with that, then the next question is, what's going to happen to Netflix going forward? When it comes to the slower and subscriber growth, I mean, everyone who wants to get a Netflix pretty much got a Netflix, and they're expanding outside of North America for additional subscriber growth. Then for the next quarters, they are expecting just like an average performance. But I think the market is still relatively positive on their performance. Here you can see the blue is what people expect, where the black is Wall Street estimate. You can see the blue is higher than the black, which means there should be a recovery coming up. Okay, we talked about that already. The reason for the drop is really because the subscriber growth is slowing down. Yeah, but I think fundamentally the business should be quite strong. The competition between Netflix and Disney Plus is just subscriber growth and then the content they have. I don't think the other streaming services will take over, given that Netflix has been around for a long time. And then the question is, well, it is still a little bit early. So if you are entering into Netflix, then I would suggest you to include a put if you have the budget to do that. Then the question is, well, what strike price should you use? Given what's happening in the market, I do think you should be more conservative in this sense. You're probably looking at just roughly $250. I think this is the most aggressive stock price to use. Let me just see what I use. 300 is the most aggressive stock price I tested earlier. 250 and 200. If you look at the previous COVID prices, pre-COVID prices, then it's around this 250, 300 range. I wouldn't say getting to 300 is unrealistic. It's quite possible if you just have a lot more market fear and then that will drive the price down. I think 300 is probably too much risk. You're probably looking at 250 or 200, depending on your budget, because Netflix is going to be an expensive option. All right. I went into the option chain and I pulled the information for you. Here are the three options that to compare, 300, 250, and 200. And the full option price here is 140, 170, and 210. This is probably going to change when the market is live. But basically, you can see for 300, the interest as a percentage of option price is 35%. And I do think there's quite a high possibility that suddenly it might drop to 300. I wouldn't be surprised. If you want to be safe, then I think go with probably 250 to 200, somewhere around here. This is the option price. So it's around 17K to 21K. When you look at the price to double your money, it is all around $600 or so. The price to double your money is actually not different by that much. 600, 620 was around here. You probably wouldn't get there within 1 year. You're probably looking at 2 years. If you don't get to 100%, chances are if you get to this 500 mark, then I think that will be a pretty good recovery for Netflix in a year time. That's how I would think about Netflix and the entry. If you are able to spread it out, then try to wait a little bit more for the situation to stabilize before entering. Separate it into two if possible. If you only have one entry, I would wait a couple more weeks to see if the Russian-Ukraine tension is kind of easing and see how that is influencing the technology sector. Rob, APN. Appian is scheduled to publish its fourth quarter and full year results after the close of trading Feb 17. In its most recent guidance calls for sales growth of 32% and adjusted loss of 0.225 per share at midpoint. One of the largest shareholders, Abdale Capital Advisors hedge fund, has been purchasing the stock. Now, the reason why I put this one in front of Etsy, even though both of them is medium risk, is because of the insider purchase. When you're looking at Appian, I can probably check, but usually funds do not have additional information, but if they are on the board as well, then I think they will have insights to additional information. Obviously, right now it's around $50. It is quite cheap. If the earnings is positive, then that would lead to an uptick. So you can see there's quite a bit of room for a positive uptick if they beat earnings. You can see Abdale Capital Management is 10% holder, which is why they're required to report it. If you don't know what this company is, then this is a workflow automation company that doesn't require them to build a lot of code. It's those automation platforms. Okay, low code development. Another data analytics automation company. When you're looking at the annual growth, you can see it is growing around 15% per year. The company itself is loss-making, but it is higher risk. So if you're wondering, this is the summary, loss-making with moderate growth. If you're looking at the quarterly, then that's when you get stronger growth, like 10% here, 5% here, but then they're still loss-making. But the loss is actually increasing, which is what makes this company higher risk. Now, when you're looking at the forecast going forward, you can see revenue forecast here is actually getting higher for the next 2 quarters, and then there's a slight dip probably due to seasonality and some contract ending dates, and then it goes higher. They are planning to expand very quickly. If you're looking at EPS, they're actually expecting to incur more losses. That's why it can go either way. Right now, we are in the middle of the technology correction. That's why you want to be extra careful when it comes to investing in them. If you know the company very well and they're expanding very quickly, then I think that is what gives you the insight to invest before earnings. If you're scared of the earnings suddenly going against you, then you might want to buy a put. Probably you're looking at something like $50 or $45, you would buy a put to hedge for the next 4 to 8 weeks, similar to what we are doing with PayPal. If you're looking at balance sheets, they do have an okay amount of cash. They are burning cash, kind of 25 million quarterly. If you times it by 4, that's 100 million a year. So they have 2 years of cash remaining. Probably by December quarter, they have 1.5 years of cash remaining if they're incurring more losses. Now, if you're looking at debt to equity here, then it is approximately 1-to-1. So I think it's not over leveraged, but they probably need to raise equity, which may dilute their shares, or later on raise debt as well within the next 1 to 2 years. But that is really the problem with technology companies, because you can see their cash balance is dwindling and they need to expand. If they need to expand, then they need to raise more capital. And right now, stock prices are really low, which puts them at a disadvantage. Okay, one of the reasons is rising interest rates. So that's what I explained earlier. And if you look at the forecast going forward, then here you can see they're expected to incur more losses. I think the only item that may suggest this earnings will be positive is that APPN is buying a lot. The hedge fund is buying a lot before the earnings date. So that is the only indicator you have. But if you're looking at earnings, it is going to be incurring more losses. Unless the company is growing very quickly, then that can be a hit or miss. If you want to hedge against that risk, then just make sure you use a put option before earnings as well when you're entering into the position. Now, chances are, even though there is January 2024 option, you can go with stocks. So you will be able to make 30% with stocks as well the moment technology sector correction is over. I think, if you want to use options, for example, you can see January 2024, you're looking at like 25. If you look at 40, you can see the intrinsic value here is 15, and then the option price right now is close to 30. So then your interest is going to be approximately half of the option price itself. You probably want a lower risk option, which is 25. I think that's the best you can get at the moment. The next stock is February 24th earnings, Etsy. The earnings date is February 24th, and it is likely to report the fourth quarter results later in February, so that is actually the date. Let me just delete the sentence for you. Etsy's website doesn't list a date. In 2021, Etsy bought Elo7, which is labeled as the Etsy of Brazil. On January 10th, 2022, CEO awarded, I think it is 100,000 shares. Let me just double check for you. 100,000 shares, and he has held on to them. Okay, and it's important to understand vesting. Let me explain what that means. Etsy is the e-commerce site that mainly serves artists and special goods. Here you can see right now it has gone down quite a bit. And similar to Shopify, which is an e-commerce site, but it is more like a platform and software as a service business, you can see both of them is at a cheap price at the moment. If you're looking to invest in Etsy, then I think you can look at the Shopify's earning coming up, which is 1 week before Etsy's, to see how it reacts. Shopify's earning is coming up February 16th, 2022, whereas Etsy's earnings is February 24th, 2022. Because they're in the same sector, then you can see what is happening in Shopify to see what's in store for Etsy. If Shopify is really good, then chances are Etsy should be going up as well. If Shopify is doing bad, then I think you can buy a put if you invest before earnings for Etsy to protect yourself. Okay, here's the summary analysis for Etsy. Now, one of the downside for Etsy is that they do have high leverage because they're acquiring other companies and they're issuing debt. So that is the concern. You just need to be comfortable with that. Usually, we want to invest in companies that have lower leverage. Now, if the company itself has high leverage and the interest rate increase, then it actually puts them at a disadvantage. That is also something else you need to consider. Yeah, I'll go through this when we're talking about the balance sheets. For the bottom, for these two, I'll put down as forming as for now because they are at a deeper discount. I think if the earnings is good, then you will start to see the first part of the W. But if the earnings is bad, then you need to wait more. It's kind of early to forming. So for insider, here you will see there's a lot of insider sell. And you see that Josh here, president, CEO, exercised 100,000 stock options. There's also a negative here. This is actually not the grant. When you say here, CEO is awarded 100,000 shares and he has held on to them, this is actually not an award. This is probably him converting the existing share options he has into shares and then probably selling them. So that's kind of what you're looking at. Usually for grants, it will actually say grants. Let me just go to an example. for you. For example, if you look at Disney earlier and you go down, then here is grants. That is really where people are getting compensation and then they get grants. When they get the grant, they might not be able to exercise that immediately. They might need to wait a year or 2 years or 3 years. That's when the options become vested and they have the ability to turn those options into shares if they want to. For Etsy, here you can see this is probably the president or the CEO exercising the option and then getting rid of it. So that's what I think is happening. That's why you need to look at these two transactions together. Usually I just ignore them. They don't really carry a lot of weight unless you think it is a sell. So here you can see the option exercise in this transaction were fully vested. This is probably something that he received a while back. And yeah, 25% of the options become exercisable May 2018. And then it will be over 39 months, for example. Then that might be the time he decided to exercise it. And then here you can see there's a lot of open markets private sale. What you want to see here is really it is selling. So the CEO is still selling the stock as of January 10th. That doesn't give you too much confidence in terms of buying the stock as of January 10th, which is here. It was actually not too long ago. And that's why I put APPN ahead of Etsy, even though APPN is a smaller company and both of them are medium risk. This is medium risk because I think there's insider sell and it is early bottom. I think this is also stepping out of COVID with high leverage. APPN, this is a smaller company, loss-making. I put this as medium risk to high risk, but there is insider buy from PE funds. I think on a balance of probability, you'll probably make money with APPN if the technology correction is coming to an end, then Etsy for now. But it's possible that both of them will be going up as well. Income statements. Here you can see Etsy is growing very quickly, 30% plus growth. And for net income, you can see it is growing as well. Now, on a quarterly basis, you can see there is a major December growth here. And afterwards, you get 3 months of kind of flat growth. That is really the seasonality of Etsy. If you look at what it's in store for Etsy, for Q4, they're actually expecting a very high revenue. Afterwards, it levels off with not a lot of growth for 3 quarters. And then Christmas comes again, and then people shop on Etsy. That is actually very similar to other winter stocks like Goose, Canadian Goose or whatnot. If you are thinking about Etsy, and let's say, for example, if this earnings is good, then Etsy stock might jump up. If this earnings is bad, then that means you're going to be holding on to it until next Christmas in order to exit. So chances are for Etsy to be fully recovered, it will need to go through the summer until Christmas time. You just need to determine if it is worth the risk. If you're buying before earnings to basically hop onto that jump, then you're looking at also buying a put as well to protect yourself. Okay? Yeah. Here you can see the key difference between APPN and Etsy is that Etsy is actually profit making. If you look at balance sheet, you can see the cash is actually declining, and that is because they recently gone for an acquisition, so that makes sense. If you look at debt to equity, this is $3 billion versus $500 million in terms of equity, which is 6 times. That is actually quite high. In fact, I can just do a quick comparison with another company for you. For example, Shopify. And we're just stepping out of the low interest rate era. Then if a company is over leveraged, I think it will actually hurt them more as interest rate is increasing. Let's say if you're looking at eBay, which is also an e-commerce company, then you can see their leverage is only 2 times. 18, this is 10. And that is almost 2 times. If you look at Shopify, an e-commerce platform company, then their leverage is actually 0.3-ish. When you think about risk, why does Etsy need to have such high leverage? One of the downside of having high leverage is that the stock price will fluctuate a lot more because your return on equity your equity is a lot smaller. So then the value of that equity will fluctuate a lot more. You should expect wild swings for a company with 6x leverage versus 0.3 leverage or 2x leverage. Usually I would say 2x leverage is what I would go for. I would be a little bit more concerned with 6x leverage. If the interest rate is going up and if they have very high leverage, it would actually end up burning a lot of their cash. when the interest rate is increased and they need to renew their loan, even though it might not hit them immediately, but it would decrease their profitability if the interest rates start increasing and their interest expenses start going up. Having said that, this is relatively a small interest expense amount compared to the net income at the moment. So you don't see the effect until later on. So that's where you're at. So I think if you are looking to invest in Etsy, I think you should also consider Shopify, given that they're in the same sector. And you should observe Shopify's earnings to see if it is good or bad, which will give you idea on what will happen to Etsy's earnings. Okay? If you're using options, I think it's okay as well. Just make sure you include a put before earnings, and you're probably looking at a strike price of 100 to 70 or 60 or so, kind of in this area. But just make sure the interest is not too high, less than 30%, then you should be okay. If you are using a put, I would probably get a put that is, for example, at less than 10% of your book value, around 130 to 120. If it does suddenly jump down, like a Netflix, Facebook gap down, then at least you'll be protected for this area, which is below the blue EMA. That is really the end of this webinar. Thank you very much for attending all the way till the end. I know you're the top 1% people that attended this webinar till the end, and you are very passionate about investing. I know you need help, then you can take investing to the next level. For that reason, please book a strategy session with me. We can have an in-depth discussion about your current situation and how I can help you. There are limited spots available to schedule a call with me, so then you need to act now and complete the application form so that I can review your situation and then we can have a chat for 45 minutes in the next couple of days. Thank you again for your time. I look forward to chat with you on the call.
That's no more. Wow, that's a long video.